Megan Brean, Global Chief Economist at Kroll Institute. Also, John Ryding is here, Chief Economic Advisor at Brean Capital on the set. Megan, you just heard the conversation that Becky was having a little bit there with Mr. Leisman. I'm curious what you think, if you're Jay Powell at this point, you need to do or not.
Yeah, so I think when we get the inflation data, it will show that the job is not done. The Fed has distinct tools for, on the one hand, monetary policy, macro policy, and on the other hand, financial stability. And so as Steve pointed out, what we saw last fall with the Bank of England is that a central bank can actually provide support to the markets in the middle of a tightening cycle. And I think that's what the Fed will continue to do. So I expect a 25 basis point hike later this month when the FOMC meets. I always expected that. I never thought a 50 basis point hike made sense. The Fed, more like any other central bank, has actually learned the lesson from the 70s, 80s that you can't engage in stop-start monetary policy or you end up having to hike even more in the end and pushing the economy into a deeper recession. So I think the Fed will continue to tighten.
John, this is sort of the argument that we heard from Mohamed El-Erian yesterday. And he basically said if you go the route of letting the market dictate to you what's happening, you can't do it. What would you do?
Well, Andrew, I think he's right in that. And, it's really about the strategy of monetary policy. And unfortunately, Chair Powell made a big mistake last week when he gave his testimony because he'd laid out a very careful strategy. Last year was about how fast we're going to raise rates. Then we were transitioning to how high, where he signaled it would be a little higher than they thought in December, and then for how long. But then last week he reopened the discussion about how fast. And the market got terribly oversold in shorting two-year notes and other front-end instruments. And then you get the problem, as Becky says, these stupid positions, these large unrealized losses, which in the case of Silicon Valley Bank was almost 100% of the Tier 1 capital.
Blame him for that, though, because
$15 billion.
There's sort of an interesting question as to whose responsibility is this. Part of it says the practical reality is if Jay Powell is in the role and he sees this happening at regional banks across the country, maybe he's supposed to take on some responsibility for saying, OK, you know what, these guys can't handle this in some ways. And then the other side is the personal responsibility of running a bank and trying to manage it properly, knowing what's exactly happening in front of you.
Well, I think it's pretty clear that they didn't see it on Tuesday, and they probably would have adopted a different tack in the testimony. But the point is, he had a strategy. And how fast was behind us. Now, I use the analogy, it's like being in an airplane and you just see takeoff. This is Governor Waller's analogy, but modified slightly. Then you're approaching cruising altitude, you're starting to level off a bit. And then all of a sudden, the pilot pulls back on the stick and you surge higher and then you get into panic. And the thing is, that's why the reaction in the bond market has been so violent. It's not just been about the contagion, which I think has been largely contained with the programs, because it's an old-fashioned bank run, and the Fed knows how to deal with old-fashioned bank runs. But it's about this the market was already massively short, the record short in the front end. And then Jay Powell opened the door to 50, markets rushed through that door, and now you had this very violent move.
If he goes 25 basis points, the reaction in the market is nothing because everyone is expecting it?
I think he should go 25 basis points and stay with the strategy. Megan's right. Inflation is still too high.